Hey there, traders. So today we do have quite a few things to discuss and unpack, especially as we head into the new week. So reports has confirmed that Trump has amped up his tariff regime on Saturday, announcing that a 30% tariff would be placed on Mexico and the EU. And this is scheduled to take effect as of the 1st of August. Now, one thing to take into account is how will this ultimately affect inflation and steer the Fed's decision moving forward. Essentially, this could be the support that the dollar needs in the short term. However, inflation could rise due to high import costs, potentially pushing the Fed's policy tighter. With everything happening, we are likely looking at next week to be quite an interesting one with a lot of volatility looking to enter into the market. And so, if you'd like to know how you can take advantage of these opportunities, I'll encourage you to stick around and ask as many questions as you'd like in the comment section below. If we jump over to the dollar index, one of the things that we can actually see that has taken place is that last week we've had the market close quite bullish in the sense that we've closed strong. And this is after last week we had a beautiful hammer that formed at the bottom of this overall ascending channel that we have drawn in over here. And that was subsequently the signal that a lot of technical analysts were kind of looking at as an opportunity to start pushing into the dollar. Now, in saying that, there was a few concerning days within last week, particularly on Tuesday, where the market had an opportunity to kind of break all the way up and break above the 20 period moving average over here, as we can see. But shortly thereafter, Trump has announced more tariff threats and sent out about 14 letters to respective countries regarding these tariffs. And that subsequently spooked investors, bringing the value all the way back down. And that leading over into Wednesday also gave us a bit of a bearish day as well. And if we scale over into our 4-hourly time frame, I'm sure that those of you that watched last week's video will have remembered that we were discussing the rise of the dollar, in a sense, that only once we had a definitive confirming break of the 20 period moving average, sorry, the 50 period moving average found on the 4-hourly time frame, we will then have enough confirmation to see the dollar actually build its way to the upside. That has subsequently happened on Monday, and since then we've seen that the dollar has gradually made its way to the upside. So that has been a successful forecast. However, at the moment, we do see that from a technical perspective, we have to kind of determine where we're going to next. Now, if we're taking all of this into account and we scale over to our higher time frames and we consider how we close on the weekly time frame, now just jumping over to the daily time frame, we see that a lot of the momentum that has been lost last week has been recovered on Friday. And this is because we had a strong payroll data that came out that acted as the catalyst that triggered the dollar rally to potentially even see 98.28 being hit as the resistance level of this week at least. Now, I know that for those of you that watched last week's video, we were looking at 99 as a all-time target, but at the moment I think 98, call it 98.30, will be a viable target to see price run up to if that is going to be the case. So essentially, one of the things that I'll also be looking for is to find opportunities to see the dollar get stronger, especially as we head into this week where there is going to be quite a few inflationary data that we're going to need to take into account as we gear to see what the Fed is going to do with interest rates. So I'd like to stress that there are certain concerns when it comes to the dollar. More specifically, the pressure that the Fed is likely to be cutting rates during the course of the rest of the year. Weak macro sentiment, structural doubts within the Federal Reserve in and of itself, with Trump pushing for Fed Chair Jerome Powell to resign his position as the chairman, and then sustained de-dollarization trends coming from opposing countries. These things taken into account is likely to push the dollar lower to the mid 90s And if we go over into the CME tool over here, like I have pulled up, one of the things that I want to highlight is that in July, we kind of quite certain that we're going to see rate cuts, we're going to see interest rates remain the same. There's a 94.8% chance that we're not going to see any cuts happening in July. However, the moment we scale over into September, we start to see that there's a 57.4% likelihood, probability that the Fed is going to be cutting rates by 25 basis points. Now, if this does not take place, because we still have a 39.6% chance that rates might stay the same in September, granted that we still have inflationary data scheduled to come out this week, if things comes out the way the Fed likes, if it comes out to a point where it encourages the Fed to keep rates the same, when we move over to October, we begin to see that the chances of the Fed not cutting rates in October reduces to 16.7%. This means that come October, there is, as it stands, if all things remains equal, 16.7% likelihood or probability that we might see rates stay the same. And this is a very low probability, with a 47.1% chance of a 25 basis point rate cut and a 34.4% chance of a 50 basis point rate cut. Now, let's look at this from a very practical perspective. Both rate cuts are higher than the probability of rates staying the same. So it is likely that we are going to see rate cuts take place in either September or October, pending the inflationary data that we have coming out this week. So if we jump over to our economic calendar over here, one of the things that I really want us to kind of start focusing on is the inflationary data that is scheduled to come out. Now, we do have on Tuesday, we have CPI data that's scheduled to come out, and the current expectation is that we're going to see a rise of 0.3%. Okay. Now, in saying that, if it comes out hotter than expected, this could ultimately strengthen the dollar and delay Fed rate cuts. However, if it comes out cooler than expected, the weight that falls on the dollar kind of reinforces weakness, pushing the Fed to likely cut rates come September, or increases the possibility of a potential rate cut in September. So with that all being said, we also have PPI coming out on Wednesday, and then we have jobless claims coming out on Thursday, with retail sales coming out on Thursday as well. These are very important data releases because they are going to contribute to the Fed's decision as to what they're going to be doing with interest rates moving forward. So obviously we're going to be keeping a very close eye on the data releases of these respective economic events and how this is ultimately going to shape the future of the dollar's interest rates moving forward. So with all of that being said, guys, we'll jump over to a few currency pairs. Now that we can look at the dollar from the technical and fundamental perspective to at least build some momentum in the short term, pending the inflationary data releases that's going to come out. If we jump over to currencies like the pound, one of the things that we'll be able to see is that the pound is now currently testing the bottom section of our ascending channel over here. Now, this is a very strong bias section, I would say, considering that we have gradually made higher highs and higher lows. And there's also a beautiful bullish MACD divergence that kind of appears over here. Scaling over into the all-time quarterly timeframes, we can see that the pound is now testing the outer parts of the band that I have over here drawn in, after just breaking with quite a lot of conviction out of the bands and closing above the 50-period moving average. So these are all strong indications supported by positive momentum on the higher time frames to see the pound building momentum to the upside. But there are a few fundamental things that we need to account for. For example, the slow GDP growth that has come out of the UK. We also see that the UK has not necessarily been performing well in terms of its interest rates, retail sales, etc. And all of these key core metrics does not necessarily position the pound in such a way that gives me enough conviction to say that this is going to be the point where the pound builds momentum further to the upside. Now, I could obviously be very wrong, bearing in mind that this is just the view that I take of the markets based on the information that I have. But the pound has subsequently been seen as overvalued, considering the fact that it's reached all-time highs, granted that its underlying metrics are not performing very well in a sense. And so when I look at this kind of structure over here, I do see that the higher time frames does suggest a potential run to the upside. But when I look at it and I kind of try and get a deeper understanding, I do see that there is still a bit of downside momentum that can be experienced on the pound in and of itself. And so I'm not necessarily entirely convinced that this is going to be the turning point unless I can see the market, I can see the pound closing back inside of my bands over here. And that's going to be the catalyst that I would use to see that this is an opportunity for the market to kind of rebuild itself, or for the pound to rebuild itself against the dollar. And bearing in mind that a lot of this depends on how the dollar is going to be performing based on its data releases. So if we scale over into our calendar over here, the only data that we have related to the pound is CPI data. Okay, so CPI data is also going to come out on Wednesday with PPI, and this could be a very strong catalyst to start shifting the fundamental framework from the pound in and of itself, with the UK CPI data coming out on Thursday as well. So when I look at these factors, I'm looking at all of the inflationary data coming out of the US, and bearing in mind that the EU has already had several rate cuts since the beginning of the year, with the dollar not necessarily having a single one. And so I'm looking at this information and I'm trying to determine where we're heading next. And from a technical perspective, I do see that there's the potential of seeing a stronger pound moving further to the upside. But granted that it has to address and take into account the underlying underperforming metrics that causes the pound to be overvalued at this particular point in time. And so my overall bias for the pound, at least in the short term, is still further to the downside. So a break below our ascending channel over here will see me probably look at the pound to hit its low over here at 33.70, and that will be the area that I will possibly see the pound want to rebound, if that is what it wants to do. So essentially, I'm waiting to see how the market is going to respond to the CPI figures coming out for the pound and also coming out for the euro. But obviously, bearing in mind that the dollar also has some very strong data releases scheduled to come out. And then scaling over into the euro dollar, my bias over and above the euro is to the downside in the short term and to the upside in the long term. This is mainly because of the fact that look at how strong we had a close above the 50 period moving average, closed with definity above the key resistance area that plagued the euro for a very long time at 114.95. Since 2023, we've seen that price was unable to break this resistance point up until last month, where we saw, up until last quarter, April, where we saw that the quarter close was very strong for the euro. And now we have this little blip over here to the downside. And so I'm not looking at this as a long-term short for the euro, but if I scale over into my lower time frames, one of the things that kind of stands out for me is the fact that we are pending a bit of a retrace. And so if you scale over into the the daily time frames, I have a little short that has been running over here. And so pending CPI data releases and also what's going to come out on the dollar, if I see a successful break of the 20 period moving average coming over here, then I can hold the position. Other than that, I will have to kind of manage this trade a bit more aggressively than I'd like to. But one of the reasons that I've entered this trade is because I have a very clear, very obvious bearish MACD divergence occurring over here, supported by other euro economic data. So guys, I really do hope that this little breakdown makes sense. I really do hope that you are able to understand what I've been sharing. And also, one of the fundamental catalysts that's going to be affecting the euro is the tariffs that has been enforced by Trump come the 1st of August. And so these are all things that we need to be very aware of. We need to be very cognizant of when making these decisions. But at the same time, this is but just the opinion that I hold. You could be obviously taking the other side of the trade, and you could be right. So in a sense, I'm just hoping that this information will give you more insight, give you more value, but at the same time help you making a more informed decision. So for the most part, guys, I hope that you have an awesome day. Have a brilliant week, and I look forward to chatting to you all soon. Up until then, keep well, and bye for now.